Brad Williams, Frugal Finance, stock market strategies. Are you an active or passive investor? If you ever ask an economist which stocks to buy, chances are you won't get a specific answer. Instead, you might hear about the efficiencies of markets. In fact, there's an old economic joke about market efficiencies. Two economists walk down a sidewalk. One is older and wiser, and the other is younger and less experienced. The younger economist says, "Look, a $20 bill," bends down to snatch it up. The old economist says, "Don't bother. It can't be real, or someone would have already picked it up." The joke is meant to exaggerate the belief held by many economists that markets quickly adjust to new information. Financial markets are said to be efficient if they leave no money on the table for very long. If there's an opportunity to make a profit, buyers and sellers will swoop in and take it. Hence the joke, a $20 bill left on the street for any length of time might not be a real $20 bill at all. Making money in the stock market? Savers have many investment options to choose from. Investing in stocks has risks, but over time, the stock market tends to have higher average returns than other popular investment options. Investors earn money on their stock purchases through dividends and capital gains. Dividends are shares of the company's net profit paid to stockholders. Dividends are often paid quarterly and are commonly associated with established profitable companies. Capital gains are the profit from the sale of financial investments. For example, when a stock is sold for more than the original purchase price. Historically, average returns for stocks, as indicated by the S&P 500, have been higher than for other investment options such as government bonds, 3-month treasuries, 10-year treasuries, etc. Stock market returns over time, 1928, 2015, 9.5%, 50 years, 9.61%, 10 years, 7.25%, versus 3-month T-bills in 10 years. You can see a significant increase. S&P has outperformed gold and real estate. Every investor hopes to earn high returns, dividends plus capital gains, while minimizing risk. An effective way to minimize the risk of investing in stocks, a relatively risky financial asset, is to diversify. Diversification means to invest in various financial instruments, not just a specific one. So a diversified stock portfolio could include stock purchases across industries, company size, and even geography. Diversification reduces risk because it is unlikely that all the stocks in a portfolio will react the same way to market events. For example, if you invest all of your money in the stock of a single company that owns several beach resorts along the Gulf of Mexico, a severe hurricane could devastate your portfolio. In other words, don't put all your eggs in one basket. One financial instrument designed to provide investors with diversification is a mutual fund or ETF. A stock mutual fund is an investment product that pools the money of many investors to purchase a variety of stocks to make a profit for the investor. Most investors simply don't have the time or money to create and manage such a fund on their own, so mutual funds offer a cost-effective way to diversify. A variety of stock mutual funds are available based on different investment strategies. For example, growth funds or value funds, and management strategies, active or passive. Stock fund investment strategies, growth fund. Managers focus on investing in companies expected to have faster than average growth and higher than average returns. These companies tend to be riskier than average. Value funds. Managers focus on investing in companies with stock prices that suggest they are undervalued. These companies tend to be mature companies that pay dividends and are less volatile than companies selected for growth funds. Investment management strategies, active and passive. The active management investment strategy relies on staff of highly paid analysts to build a portfolio of stocks. The goal is to earn high returns that outperform the stock market. Such analysts use research, forecasts, and judgments to recommend whether to buy, hold, or sell the given stock. Analysts are always on the lookout for the best values or companies with strong growth prospects. Active investing relies on differentiating between stock value and market price. Warren Buffett, often called the most successful investor in the world, says, "Price is what you pay, value is what you get." A stock value is based on projected future earnings and growth prospects for the company. If a stock is determined to be undervalued, that is, believed to have a greater value than indicated by its market price, managers will buy it for their mutual fund. When the stock price rises above its value, they will sell it and earn capital gains for investors. Fund managers might also sell stocks in the portfolio that are predicted to underperform the market. This buying and selling accrues transaction costs, which reduce net gains. The most successful mutual funds are those that consistently outperform average stock market returns. The passive management investment strategy is based on the efficient market hypothesis, which states that a stock's current price reflects all relevant information about its current and future earnings. How is this possible? Stock prices change when information about the company or the economy changes. Imagine you hear the reporter on your favorite stock market news channel announcing Chatport Technologies has just received a patent on a revolutionary new product. You consider buying Chatport stock because you predict the new product will reap huge benefits for the company and its shareholders. Just as the reporter says the words received a patent, the graph on the screen shows the stock price has increased 10%. As it turns out, you were not the only investor who, upon hearing the news about Chatport, decided the stock was undervalued and is willing to pay a higher price for the company's stock. When news indicates the stock is undervalued, market participants respond by buying the stock, bidding it up to its fair value. When new information indicates the stock is overvalued, investors quickly sell, putting downward pressure on the stock price, moving it back to its fair value. The EMH says the new information about a stock is priced in almost instantly, raising or lowering its price. For this reason, the EMH says the market price is the best reflection of stock markets based on current available information. And if price reflects all available information, EMA suggests that the best strategy is to buy and hold a diversified portfolio and minimize investment costs. The passive strategy holds that the stock market is so efficient that active managers will not consistently beat the market because they will not be able to consistently pick undervalued stocks. And the extra research and transaction costs involved with actively managed mutual funds, which are passed on to investors, will offset gains. Although some actively managed mutual funds do outperform the market, data consistently shows that a majority of them fail to outperform market averages reported by various indexes, including the Dow Jones Industrial Average and the S&P and Wilshire. Application of EMH index funds. One type of mutual fund that follows a passive management strategy is an index fund. The goal of an index fund is to replicate the market by simply buying the stocks included in the stock market index, such as the S&P 500 index. For example, for a given index fund, if Chatport Technologies were to represent 1% of the value of the S&P 500 index, the index fund manager would invest 1% of the mutual fund's assets in Chatport stock. The S&P 500 index includes 500 of the largest publicly held companies in the United States, which means that mutual funds that replicate the S&P 500 index hold a diversified blend of large company stocks. An advantage of index funds is generally lower investment costs. Rather than paying the research and transaction costs of active management, index fund managers simply buy and hold the stocks on a given index. Some research estimates that passive investment strategies save U.S. investors about $100 billion annually. One of the reasons economists tend to favor index funds over picking individual stocks. Conclusion? Investors who choose to invest in stocks through mutual funds have a decision to make. Do they prefer an active or passive management strategy? Mutual funds that use active management strategies rely on the research skills of analysts to differentiate between a stock's value and its market price. Index funds, which use a passive management strategy, rely on the efficiency of the stock market to price stocks at fair value. Both types of mutual funds provide investors with diversified portfolios of stock. In the end, the choice is up to individual investors. Do they believe analysts can outperform average stock market returns by finding value others have missed, or that the stock market is efficient and leaves no money on the table? Are you a passive investor or are you an active investor? Comment. Provide any hints, tips, clues, strategies? Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.